What if I told you that one market, a market almost nobody talks about, quietly decides your mortgage rate, your car loan, and your credit card interest, and even warns the world before a recession hits? It's not the stock market, it's something way bigger. And in the next few minutes, you'll understand it better than most adults do. Let's start with a story. Meet Mia. She wants to start a lemonade stand but needs $100 for supplies. Her neighbor, Mr. Sam, says, "I'll lend you the 100, but you pay me back 105 in 1 year." That extra $5? That's interest. And that little IOU note Mia hands him, "Congratulations, you just met a bond." A bond is just a fancy IOU. Someone borrows money and promises to pay it back later plus interest. Now imagine that instead of Mia, the borrower is the US government, and instead of $100, it's trillions. The government needs money to build roads, pay salaries, and fund programs, so it sells IOUs called Treasury bonds to investors all over the world. The US government is the biggest borrower on the planet. Here's where it gets interesting, and this is the part that confuses everyone at first, so pay attention. Bonds get bought and sold, just like concert tickets. Let's say Mr. Sam doesn't want to wait a year for his money. He sells Mia's IOU to someone else. If people are feeling scared about the economy and want safety, they might pay more for that IOU, maybe $102 instead of the original 100. But here's the twist. The $5 payout at the end of the year doesn't change. So if you paid $102 to get $5 back, your actual return, your yield, just went down. That's the golden rule of bonds. When bond prices go up, yields go down. And when prices go down, yields go up. They move in opposite directions, like a seesaw. Remember that, it'll make the news make sense forever. So why should you care? The Treasury yield, especially the 10-year one, is considered the most important interest rate on Earth. Banks use it as their baseline. When the Treasury yield rises, mortgage rates rise, car loans get pricier, credit card interest climbs. When it drops, borrowing gets cheaper. So next time you hear someone on the news say yields are climbing, you'll know exactly what that means for your wallet. But here's the wildest part. The bond market can actually predict a recession before it happens. Stick with me for 60 more seconds. Normally, lending money for a longer period of time means you get a higher yield. More time, more risk, more reward. That's a normal yield curve. But sometimes short-term bonds start paying more than long-term ones. That's called an inverted yield curve. And historically, it's one of the most reliable recession warning signs we have. Why? Because during uncertain times, investors panic. They rush to buy safe long-term government bonds, a move called a flight of safety. That flood of buyers pushes long-term bond prices up. And remember our seesaw? Prices up means yields down. The whole curve flips upside down. This is why traders often say the bond market is smarter than the stock market. It's less emotional, more forward-looking, and it often moves before bad news even hits the headlines. So next time you hear yields are rising or the curve just inverted, you won't just nod along, you'll actually get it. It leaves you with a final question to consider. If you had $1,000 right now, would you choose the guaranteed steady return of a government loan or take on the risk of the stock market? The answer reveals a lot about your own financial thinking. Understanding bonds isn't just about understanding the economy. It's about understanding the fundamental choice between safety and risk that drives all of our money. Tag a friend who needs this, share it, and follow Centless Teens for more stuff they didn't teach you in school.